We all know the story of a massive celebrity or a professional athlete who signs a multi-million-dollar contract, completely sets the world on fire, and then just a few years later files for bankruptcy. We watch this happen and we ask ourselves, how is it mathematically possible to make hundreds of millions of dollars and lose it all? The answer is actually incredibly simple, and it exposes the biggest trap of the middle and upper middle class. Earning a massive income does not make you wealthy. Welcome back to Wesley Wealth. I am your host, Wesley, and today we are in part 4 of our 7-part miniseries on the hidden laws of money. Today, we are breaking down a law that completely shifts how you view your paycheck. Law number 4 is this: cash flow keeps you alive, but equity makes you free. To understand this, we have to clearly define the difference between the two. Cash flow is the money that you need today. It is the capital that funds your current lifestyle. It pays your monthly mortgage. It covers your car payments, and it pays for your vacations. Whether you are a mid-level manager or a high-powered CEO, your salary is just cash flow. But here is the problem with cash flow. The second you stop working, the cash flow stops flowing. Let's look at the incredible story of Mike Tyson. During his historic boxing career, Mike Tyson earned over $400 million. But as his income skyrocketed, his lifestyle rose to match it. He bought massive houses, luxury cars, exotic tigers, and funded a massive entourage. Then the boxing stopped, and the massive income train stopped with it. But his lifestyle expenses did not stop. Because he had built massive cash flow but very little sustainable equity, he was forced to file for bankruptcy in 2003, owing over $23 million. The problem was not how much money he made. The problem was that he had zero buffer between his income and his spending. You see this exact same pattern with professional athletes in the NFL. An astounding 78% of NFL players find themselves in similar financial ruin within just 2 years of leaving the league. They make a massive high income for 3 to 5 years. They expand their lifestyle to match that paycheck. And when the income dries up, they go completely broke. High income with zero spending habits always ends in disaster. This is something called the lifestyle tax. When people start earning more money, they almost always spend more money. Their lifestyle expands right alongside their paycheck, leaving absolutely nothing left over to actually invest. Let me show you how crazy the math on this gets. Take a very high earner making $500,000 a year. Let's say they have a massive lifestyle tax, and they are only saving 5% of their income. That means they are putting $25,000 a year into investments. Now take someone earning 3 times less, making $150,000 a year. But this person avoids the lifestyle tax and saves 35% of their income. That is $52,500 a year going into investments. After 20 years of compounding at a 7% return, the person making 3 times less money is vastly wealthier than the high earner. That is because true wealth is simply the gap between your income and your ego, multiplied by time. To build equity, you have to build what we call a wealth buffer. You take what you earn, you subtract what you spend, and that leftover number expressed as a percentage is your buffer. If you make $10,000 a month and you spend $7,000, your wealth buffer is $3,000, or 30%. If you keep your buffer over 30%, the magic of compounding starts to work aggressively for you. Once you have that wealth buffer, your only job is to use it to acquire equity. Equity is the wealth you create for tomorrow. You have two options to get it. You either own your own business, or you use your cash flow to buy a piece of someone else's business. Buying shares in publicly traded companies like Amazon, Tesla, or Google is buying equity. When you own equity, you want to hold on to it. The absolute best investors do not build companies just to sell them for a one-time cash out. They build them to create an equity flywheel. Look at the strategy behind Acquisition.com. They are a business that builds other businesses. They use their brand to attract new companies, which drives their advisory business, their education business, their venture arm, and their real estate business. They have built a massive compounding machine, and they have absolutely no plans to ever sell it. They just want to buy and build for years to come, because holding the equity is where the real power lies. But how do you actually start acquiring this equity for yourself? The biggest mistake people make is freezing up because they do not know what kind of investor they are supposed to be. When it comes to acquiring equity, there are three types of investors, and you have to pick the role that fits your lifestyle. The first type is the active investor. Active investors are in the trenches doing the day-to-day work. If you are a real estate investor actively going out to find properties, negotiating the deals, renovating the kitchens, and managing the tenants, you are an active investor. If you are a day trader staring at charts or a private equity manager sitting on corporate boards, you are active. You are a full-time, professional investor trading your time and expertise to force your equity to grow. The second type is the thematic investor. A thematic investor focuses on investing in future trends that they deeply believe in. You are not managing the day-to-day operations, but you are choosing the direction. For example, if you believe that artificial intelligence is the most important theme for the next decade, you might go out and buy an AI exchange-traded fund, or ETF. If you believe the country of India is positioned for massive economic growth, you invest in an India-focused fund. You pick the theme for the future, and you allocate your wealth buffer alongside that theme. The third type is the passive investor. A true passive investor simply gives their capital to an active investor and lets them do all the heavy lifting. For example, you might decide you want to own real estate equity, but you have a demanding full-time job and absolutely no time to manage a building. So, you find a commercial real estate operator doing a massive multifamily apartment deal. You provide a portion of the capital, and they go out and acquire the property, manage the renovations, deal with the tenants, and eventually send you your share of the returns. Even massive venture capital funds operate this way. When a legendary firm like Andreessen Horowitz raises a $15 billion fund, the people putting the money into that fund are passive investors. The venture capitalists themselves are the active investors who go out, vet the startups, manage the capital, and guide the businesses to an exit. But here is the golden rule you must memorize if you want to be a passive investor. If an investment is completely passive for you, it has to be highly active for someone else. You cannot have passive investors putting money into passive things that are managed by other passive people. That is a recipe for losing all of your money. You are simply providing the fuel, but a professional still needs to be driving the car. Cash flow is the oxygen that gets you through the month, but equity is the empire that sets you free. Your goal starting today is to avoid the lifestyle tax, build your wealth buffer, and aggressively acquire equity. Now, when you start pushing your surplus cash into the market, you have to understand exactly how to balance your risk, which brings us to law number 5. In the next video, we are going to completely shatter the myth that risk and reward are equal, and I will show you exactly how the wealthy swing for massive, life-changing returns while completely capping their downside. If this video opened your eyes to the trap of a high salary, please hit that like button and subscribe to Wesley Wealth so you don't miss the rest of this miniseries. Drop a comment below and let me know. Are you currently an active, thematic, or passive investor? I want to hear your strategy. I will see you in the next episode.